Hello, investors. Markets have seen some bit of volatility in the past few sessions. So, in such a scenario, many investors tend to doubt in terms of what they should do on their systematic investment plans or regular investment into the markets. So, in this video, we would analyze what are some of the key aspects which you should be mindful when you do a systematic investment plan into any mutual fund portfolio. So we would go through the basics in terms of how an investment manager should look at their portfolio or should approach portfolio construction. So in this slide on the left side, you would see three stocks, stock A, B, and C. So all three of them have a price at which they are currently trading. For simplicity, we have assumed the stock to trade at 100 rupees. And as an investment manager, he would have an estimate in terms of its fair value or intrinsic value on a forward basis. Generally, markets tend to be forward looking, and therefore to analyze the value of a stock, generally investors tend to base it on forward earnings power or some other fundamental metric, which is probably 1 year forward or 2 year forward in nature. So in this case, based on the investment manager's estimate, stock A should have a fair value or an intrinsic value of 130 rupees. So as and when the market recognizes its true potential, there is a possibility to earn an upside or a stock return of 30% in this example. Similarly, when we come to stock B, the stock is currently trading at 100 rupees. And the fair value estimate or the sell limit is estimated at 125 rupees, which gives a potential upside of 25%. So when you have a portfolio which is constructed with such names, which has a potential upside over the next few years, generally people tend to look at a 2 year forward number because that is something which is more practical in terms of forecasting ability, and it makes sense to have a long-term perspective. So when you multiply the weight of a stock in the portfolio, multiplied by its potential upside, you would end up with a number which would be that particular stock's contribution to the portfolio upside over the next for the forecast horizon. So in case of quantum long-term equity value fund, we generally tend to look at a 2 year forward number. So in this case, stock A can help the portfolio to have an upside of 10% over the forecast horizon. Similarly, when you add up the upside of individual stocks in the portfolio, you would end up getting the portfolio upside. So in this scenario, as you add up the individual upside of every stock, you are coming up with a portfolio upside of about 25%. So on the right side of the slide, you would see another portfolio which is constructed of three stocks, which are stocks D, E, and F. And in case of stock D and E, the sell limit or the fair value estimate is lower than the current market price. For instance, in case of stock D, the fair value estimate is 100 rupees, whereas the stock is currently trading at 120 rupees. So as and when market recognizes its true potential, there is a possibility that the stock can give a negative return of 16.7%. Similarly, in case of stock E, there is a possibility that the stock can give a negative return of 20% as the market recognizes the stock's true value as and when the time progresses. So when you add those individual downside or upsides of individual stocks, in case of portfolio B, you get a portfolio upside of minus 5.7%. So as the market recognizes the true potential of this portfolio, there is a possibility that the portfolio could decline by 5.7% over that forecast horizon. So if you are a long-term investor, you should always be cognizant that you should invest in a fund which is always, which gives importance to an absolute upside. And if you invest in a set of overvalued names, there is always a possibility that as and when time progresses, you could end up with a negative return or a suboptimal return potential. So in the next slide, you would see the outcome of following a disciplined process over long periods of time. So in terms of quantum long-term equity value fund, we have fairly strict buy and sell limits, and we are quite sensitive to valuation. So as and when the stock crosses our sell limit or fair value estimate, we would start trimming those positions. And as a result, the possibility of having many names with downside potential or negative return potential is quite less. So at any point in time, our portfolio is likely to have a positive upside because it is comprised of a set of stocks which has upside on an individual level. So when translating this to long-term return potential, the possibility is that the SIP returns, or if you are an investor, patient investor investing continuously for a longer periods of time, your experience is likely to be reasonable. So in this chart, you can see the SIP returns and the trailing returns of quantum long-term equity value fund versus its benchmark. So generally what we have seen is the SIP returns tends to be reasonably good over long periods of time. You take a 3-year return or a 5-year return, or any period for that matter. So at least if you stay invested for a 2-year horizon, which is generally when we base our sell limit or the intrinsic value estimate. So you tend to have a reasonable experience in that sense. So therefore, when you do a systematic investment plan, you should be very cognizant that the fund manager follows a systematic approach and holds a set of stocks which has the potential to earn return over your investment horizon. So even if you look at our longer term trajectory, that is kind of that's a testimony to the process which we have followed, wherein the investor had a reasonable experience over long periods of time. So just to conclude, there are two critical things which you have to be mindful when you do a systematic investment plan. One, you need to continue the investment for an investment horizon which kind of matches with the fund manager's investment horizon. And so that, the sell limit or the intrinsic value estimate which the fund manager has generally tends to be realized over long periods of time. So if you have a 6-month investment horizon, the sell limit which the fund manager has estimated may not be recognized. Therefore, it's important that you have a long-term horizon. And number two, the fund where you invest should be cognizant of an upside potential at a portfolio level and should be sensitive to valuations on an overall portfolio level and even on the individual names. So with that, I'll conclude this video, and happy investing.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.